there, so it's not fair for them to be waiting.
No, I agree. Good afternoon, everyone. We want to thank you for joining the webinar. Again, the theme is startup strategies for gaining and sustaining momentum. So whether you are a startup or a later stage company, there's always questions that you have from a legal perspective, from a compliance perspective, and others that you are concerned with on how to navigate through your company. And so these are some of the things that we're going to discuss on the webinar today. We're going to address some of the legal and compliance concerns that a company is faced with, and again, some tips on how to navigate through those challenges. And although when you think about legal and compliance issues that face any company, the list probably is very extensive. But realistically, in view of the time that we have, we're going to focus on just a few key points and then look forward to other discussions where we can expand broader. Just a few housekeeping items. We're going to allow for a few question and answers at the end of our discussion. We're looking for an interactive discussion, so we ask you to keep your phone on mute now, but when we open it up to questions and answers, using the raise hand feature on Zoom, we look forward to your feedback and to your questions as well. So we're ready to get started. My name is Wayne Brown. I'm the managing partner of the Walker Group, which is a fintech boutique consulting company. And we sit at the intersection between fintech and banks, and we continue to add value on both sides of the equation. I'd like to introduce you to the panel. Ross Pitcoff is going to introduce himself and give you an overview of where he plays in the legal space. Ross?
Yes, hello, thank you, and good afternoon, everybody. My name is Ross Pitcoff. I'm the founder of Ross Pitcoff Law. We are a commercial litigation and company representation law firm here in New York City. And we work with startups and small businesses, especially in fintech, with a focus on company formation, due diligence preparation, and getting companies ready for capital raises.
Thank you. Thanks, Ross. Buck, would you like to introduce yourself and provide your background?
Sure. Thank you, Wayne. Good afternoon, everyone. I'm Buck Kulkarni. I'm based in New Jersey, USA. And I was fortunate to work a gamut of corporate roles, starting as a developer in Citibank, and then moving through a variety of roles, and eventually kind of got specialized in fintech space. I was the president and COO of a couple of fintech organizations, and I was involved in a lot of digital transformations. So all these experiences I bring together to form what I call Startosphere, which is my vision about how I help the startups navigate through the initial difficulties. So that is what I'll be talking about today, and hopefully you are going to find it enjoyable and also useful in your work. Thank you.
Thank you, Buck. So I'm the moderator for the discussion that we're going to have, and so we have a series of questions that we're going to ask both Ross and Buck, and then again, as mentioned later on, we're going to look for your input as well, some questions that you may have as we continue with our discussion. So Ross, we're going to ask you the first question. We know that companies today question when is the right time to incorporate their business. So from your perspective and your background, what do you think is the right time for a company to incorporate?
Generally speaking, I'd say the answer is as soon as possible. And of course, it's going to depend on a number of different factors. So for example, if you're a sole proprietor and working on your own, you have a lot more flexibility than whether or not you have founding partners. But if you have partners from the get-go, the very first thing you're going to want to do is incorporate your business. That way you can set up an operating agreement or shareholders agreement. You can have a founders agreement between the partners, which we can discuss later on. And you can make sure that there's a framework to protect yourself from personal liability. Similarly speaking, the second you enter into a contract with any sort of employee or a contractor or a vendor to purchase items, a commercial lease, you're going to need a business to protect yourself and also to ensure that you have a separate entity that can essentially enter into agreements. The same thing can be said if you want to get an investor, unless this is a very close family member, such as your significant other or father or mother. Any legitimate investor is going to want to see a company, and you're going to want to be able to lay out the equity ownership distinctions between you as a founder and what that investor is going to get. Also, if you're registering intellectual property, I think that's another area to be mindful of. The moment you register IP, you're going to want that IP, typically speaking, in the company name. So that way, when you're finally at a position where you're actually getting investments, they're able to see that the IP is registered in the company's name.
It's an interesting perspective. So, from a legal perspective, it's very important to have a partner early on in the process. So, Buck, as you mentioned, your background kind of stresses on the compliance side. So governance is usually seen as something that large companies have as part of their strategy, public companies, big companies. But you've mentioned the fact that even small startups need to look at governance as really their day one strategy. So can you describe, again, the concept of how you are defining governance and kind of talk us through why you think it's so important at the early stage to kind of have some conversations around governance as part of the overall strategy?
Sure, yeah, that's a great question. Only thing is, if I don't stop after 2 hours, please stop me. So you're absolutely right. Governance is seen as something very large. There is a board committee and that does governance and this and that. But that is all, the visible aspects of governance. And that's not what I refer to when I talk about governance. In fact, governance is more important for smaller companies. But we have to just remove these layers of formality around this word. Because governance, the way I like to look at it, is it's simply a platform that supports the realization of your vision through concrete and shared steps. As you have seen when yourself in your long association with many startups as well as fintechs, what are those goals? How do you share that with the team that you have? Sometimes we think that, hey, we are just a team of 6 people. What is there to share? Everybody knows everything. But that is absolutely not the case very many times. So we can go into much deeper into all these aspects. But to begin with, I will say it's simply a platform that you build from day one that will support the realization of your vision through concrete and shared steps.
Okay, thank you. We're going to shift a little bit with regards to startups and when startups kind of get started and the multiple partners that they have. And obviously, as a startup grows, there are more partners that they engage with in order to grow the company and ultimately increase revenue. So often startups consist of multiple business partners in addition to the founders. And so Ross, what type of consideration should founders be aware of when they begin to piece together the deal terms amongst their partners? And interestingly enough, sometimes when they don't do this correctly or the right way, they can encounter some problems down the line systemically that can hurt them. Can you talk a little bit about that?
Absolutely. That's a really great question. I think first and foremost, often there's confusion between setting up a company such as an LLC, which requires an operating agreement, and setting up a corporation, which requires a shareholder agreement, and then a founder's agreement. So really, I think it's important to understand that the agreement, an operating agreement or a shareholder agreement is an agreement with a company. But then amongst the founders, it's often very helpful to have an agreement amongst themselves. And in those types of agreements, you can really outline a lot of the things that you want to accomplish, the issues that you expect, the risk that you intend to, will probably have to run into, and sort of outline a number of the protections you want for yourselves as initiating founders of a new venture. So examples of that, you might want to set the expectations of the company. So the goals of the founders can be written out. And what is the timeline for success? Another issue you might want to piece together in a founder's agreement are the roles and responsibilities of the founders. Is one founder going to be strictly focused on business development? Is one going to be focused on the financing aspect and another focused on the actual product itself? These things might sound sort of too preliminary when you start, but the reality is they're not, because if you run into trouble early on, you could wind up sinking a business very fast before it ever even takes off. Other things to consider is equity distribution. How is that going to work? How much is each founder going to take on? How much are they willing to be diluted in the future? Will there be salaries? Are they going to be salary founders, or is this just sweat equity? Also, what happens if a founder wants to leave, for example? Is there going to be a buyback option? Is there going to be a mandatory transfer of ownership of shares? So certainly issues like that, issues of dilution, and even confidentiality amongst the founders to ensure that whatever trade secrets, the ideas we're piecing together, are only going to stay within this company is essential to see in writing. So I think at the end of the day, a founder's agreement is very important. It really sets the expectations and outlines the future of where the business is headed, and also comes up with solutions for issues that may arise really down the line.
No, that's good input. Thank you. And interesting on the webinar, we have a number of CEOs, a number of founders, a number of companies that are startups, some late stage companies as well. So a lot of this information, obviously, some companies that are on the webinar may be aware of, and others perhaps maybe can start thinking about this to make sure this is incorporated in their company. One other question, Buck, that I have for you with regards to kind of taking this now around products and services. What are some of the key factors that you recommend entrepreneurs or CEO founders to consider while determining their offering and their product services?
Yep. No, that's a very important question, because if we make a list of the top reasons that bring down a startup or put a startup in a difficult situation, one of them is the product mix and the product and services combination. There can be a lot of debate or difference of opinion in the founders, which is not clear to begin with, because when you have got just two people doing something, everything looks very easy because all of you have got the same vision or whatever. But it is not so. And I have personally worked in companies which got into a lot of trouble, including dissolution, because the founders could not agree on what their product mix was. So this goes back to what Ross was talking about just a minute ago. Is there a formal understanding and agreement as to what the company is going to pursue and who is going to do what? And in fact, right now I'm living through those challenges. So it's very important. What is your offering? That definition should be there upfront. It doesn't mean you to become rigid. You can be flexible, things change, and you must change as per the market demands. But at least there has to be some basic, the clarity, when I can say that it starts in very subtle ways. Like a lot of entrepreneurs, especially younger ones from the technology field, they have got this notion that, oh, I'm creating something, sexy. I'm creating a product, and I don't do this body shopping kind of work. And sometimes great opportunities that are in front of them, they just end up ignoring or not even noticing those opportunities because they're so fixed in their mind about what they don't want to do. So those kind of things, I'm perfectly fine that somebody doesn't want to do a particular activity, which they call body shopping or any such term. But that does not mean that it is not going to be a part of your ecosystem. And I think that's a very important distinction entrepreneurs need to make as to what is the total ecosystem that you need to build to deliver a satisfactory solution to your customer. And out of that, what you want to do and what you don't want to do is a separate discussion. But what you do or what you don't do should not be the limit for your company. That's the most important thing I'll tell entrepreneurs all the time. Because sometimes without those services, without that essential layer of services, your product does not bring value to the customer's business. And if that happens, then no matter how good your product is, it's not adding value to the customer. And after some time, he may say that, hey, your product is great, but really, I don't know, I don't have much uptake for that in my company. So, I'm not able to use it a lot. So, and you start falling behind. So quality of product is definitely enhanced by the quality of services. That's one thing I would like all the entrepreneurs to keep in mind. Does that answer your question, Wayne?
Okay. Yes. So let's continue on those lines. Ross, sometimes entrepreneurs, they come up with a great idea. They become fixated, though, on the brand name for their product. And they're obsessed with the brand name for their product. But often the case, they never confirm that that brand name for their product isn't used by another business. Because imagine, great product, emotionally attached and tied to it, even from a business perspective, somebody's got that name. What's the best practical advice that you can give a startup when it comes to intellectual property? And there's a lot around that, but just kind of focusing just on that alone can certainly be very insightful to some of the founders and CEOs and stakeholders on our call.
Absolutely. I think first and foremost, the answer is register. So it's the big R word to keep in mind. You may have a patent, you may be seeking a patent, a utility patent, a design patent, whatever it may be for your product. If you have that idea, and obviously there is a financial concern with ensuring that you can get to that point of registration, but you need to go ahead and do it as soon as possible, because the second somebody else slips into the market with a highly competitive or similar product, you're going to have trouble. The same thing can be said with copyrights. I would say the same thing for trademarks. And to the point that you were making and asking the question, it's amazing how many times you find that a founder or entrepreneur does become tied to a name. Maybe they ran a quick Google search of their competitors, didn't see anybody in the same area, in the same marketplace with that name. So they go to market, everything's going fine. Maybe they're even able to obtain an initial investment without showing that they have a trademark for the brand name, but now they're entering into a new geographical location and suddenly they get hit with a cease and desist letter, and potentially even worse, with a preliminary injunction that essentially stops them from using the product in commerce. Now you have a major problem where you need to completely redo your branding, completely redo the entire strategy for how you're going to be able to conduct your business. And for those reasons, the best option is to register as soon as possible to ensure that you're able to obtain the rights to whatever brand name you're using. And certainly if we're in the patent or copyright world, the same theory applies. Now, just one add-on to that is, and I know we're going to discuss capital raises in further detail shortly, but anytime any investor or VC comes in and wants to do due diligence, one of the first things they're going to ask for is, can we see your intellectual property registrations? So if you're in a position where you simply don't have those to show, it's a red flag right there. Is it insurmountable? No, it's not, but it's something to keep in mind. And I know when we get to capital raises, we'll be able to discuss some of these details a little bit more.
Okay, thank you. I think that makes a lot of sense. We're going to look forward to having that discussion about capital raise because it just certainly does tie in. So Buck, a startup may not have the resources to complete a product or service. And I know you come into that situation a lot where they need help. So how do they bridge the gap between what their startup offers, what the customer needs?
Mm-hmm. In fact, when you and me have been in situations on this. So this is a very important point, and if not addressed upfront and correctly, it can become a huge obstacle for the startup to difficult to overcome. So first of all, understanding what your core offering is, but what else is required to convert that offering into a usable service for your customer. This is the real big distinction. Your core offering may be great for you. You might be very excited with that. As you can see, for example, there are many things, especially with AI and machine learning, that's now so prominent. Solutions are growing very fast, and you can come up with some great analytics idea, great analytics tool. And especially if your target customer is going to be a bank or a large organization which has got a lot of compliance obligations of its own, then to make your component usable is a very, very different challenge. It's not just about how good your component is. So what's the total ecosystem that you need in order to deliver value to the customer? Where in that is your component fitting? Who others you need in your ecosystem to complete the value chain? So it could be somebody, a big guy like an AWS or Google Cloud behind you at one end. On the other end, there can be a small front-end guy who has developed a perfect dashboard that kind of takes what you generate and present it in a nice, easy, configurable manner to the end user. Who are the people who onboard? When you know this more than anybody else, you can have the greatest product in the world today in fintech, but if a bank has to onboard a customer or an organization, corporate customer, retail customer, whosoever, unless there is a very strong AML KYC review done and certification is obtained, that customer cannot go live in the bank's application system. End of story. It doesn't matter what you offer, what you do, how great your product is for the bank. So how is AML KYC going to be done on your product? If your product participates in a value chain where you are going to collect some credit card information, who is going to be responsible for getting the PCI compliance? Is it you? Is it the bank? Is it the end customer? Not understanding these things and not having partners to fulfill that part of the value chain will essentially not get your product off the ground. And that is what I keep talking about, that the entrepreneur has to bridge the gap between his core offering versus what is the whole thing that the customer needs to actually put it to use.
No, that's a very good point, and very realistic. Some of the pain associated with it, you have a great fintech, great product, and can't get their product through the bank because some of the challenges that they're not aware of that they need to have be upfront with in order from a compliance and KYC to get their product live within that bank. Excellent point. So Ross, what is the best way a company, what the best thing that they can do to protect themselves once they're active and doing business? One of the things that we do continue to see in our work and our practice is some startups sometimes don't have the trajectory, the runway in order to survive. And that's a real challenge, especially in the times that we are dealing with now with the pandemic and other things that becomes challenging. So what's the best way what a company can do to protect themselves once they're active in doing business?
I think that's very true, and especially now, it really becomes more important than ever to be lean, because the companies that are very disorganized from the start, the companies that aren't positioned properly to know when it's time to open for a new round of investments, are the ones that are going to suffer more, simply because the economy is seeing some uncertainty given everything that's going on. Just from the foundational perspective, number one is put everything to writing. So we start off with your founders agreements, with your operating agreements and shareholder agreements. Those should be in writing. All of your employment contracts and vendor agreements and agreements for public relations and digital marketing and asset purchases. Those are essential. The leases, things that we've, maybe even discussed earlier on this call. But the bottom line is, every step of the way, things need to be detailed to ensure, for a number of reasons, that you're going to stay out of litigation. And that's important for two reasons. Number one is, you don't want your brand name to take a hit, because the second you're involved in litigation in the public forum, you could potentially come up in Google searches. And, we've seen it many times before. Companies got a rosy leader, everybody's, focused on how terrific they are. And suddenly there's, some sort of contractual case that goes into court, things change. Secondly, by having everything papered, when you do start to enter into capital raises, those investors will be able to see that you're tidy and you've got your ship in order. One thing I do recommend, and I would be curious to know about our audience, in fact, I might put up a poll here briefly, is I always suggest to my clients to have mandatory arbitration clauses in all of their agreements. And I think that's a valuable addition to when you're building your company to be mindful of, because in those instances, in the event you do have to go to dispute resolution, you can stay out of the public eye. Now, it doesn't mean when an investor comes to you and they run due diligence that you don't have to disclose the fact that there's been any prior, current, or anticipated litigation, but it does mean that from a brand perspective, you're able to save face and ensure that these things aren't going public. So it's something to keep in mind, and I'm actually curious to know within our audience if anybody has, if anybody's very mindful and ensures that their clauses for arbitration are in all of their agreements. So maybe we'll get some responses.
That's open to our audience then to complete that questionnaire that's there?
If they choose, yes.
Yeah.
Okay, we're seeing a mix come in. It looks like 40% say no, and about 17% are saying yes. I don't know if everybody can see this. It looks like almost half the audience is saying they're not sure if they have arbitration clauses in their agreements. I'm sure the numbers will fluctuate a little more as people respond, but these are important things to consider and think about.
Excellent, thank you. In addition, what I want to do is kind of jump on a few more questions, and then I want to open it up to the audience for some questions, and then we can go back to some of the Q&A. The reason why is because I'm sure if I was in the audience perspective and I've heard this dialogue go through, there's some things that kind of come to my mind, and I think we want to kind of get that interactive conversation a little earlier than what we might have thought about, if that makes sense. So we're going to ask one question to Buck, and then we're going to go through some Q&A with the audience and kind of have some type of interactive conversation, and then go back to some of the other questions. So Buck, your question is, what is product management from a startup perspective? And is it something a startup must invest in day one? What's your thought on that?
Sure. This is actually the same thing that Ross was speaking about a minute ago from a legal perspective, that, all these agreements and MOUs and arbitration clauses are the governance that I keep talking about, product management. All these look like very big terms, and a startup really doesn't have time or the energy or the resources to get all these done. And sometimes they tend to get ignored, and most of the time the thinking is we'll do it when we come to it, but that's exactly the tendency to avoid, I recommend, because you need this much more importantly in the early stages of your business when you've got very little bandwidth to fight anything. You want to be able to focus all your available capabilities on building what you're building, rather than get into arguments or, like Ross mentioned, your name coming up in a Google search for litigation and all those things, because you don't have really the bandwidth. I mean, if you're a large company and you've got a 400 people legal department and it goes on, it's just a part of life for you, then it's a different story. But not if you're a startup with 4 or 5 people trying to work 18 hours a day and build up something. So from product management, I will put in the same category. You must invest into that from day one. And when I say invest, it doesn't necessarily mean money. It's the discipline that we need to have to manage our product. Managing the product is what is the roadmap? What the product will be 6 months from today, 12 months from today, 18 months from today. What will that product have in terms of the technology stack? How does it fit into? I'll give you simple examples. I don't want to get too technical because we have got a mixed audience. But one example is worth taking. You're a startup and you are a techie, or let us say you're a startup in a completely non-technical area. Let us say you're building a product that will become an exchange for agricultural products. And you have your own idea. You use a lot of open source tools that come to you free. And you build your product. And then some larger organization gets interested in what you're doing. Maybe they want to acquire you, maybe they want to invest in you, maybe they want to become your customer and bring their customers onto your platform. And one of the things that is going to hit you bad at that time is they will ask you for a list of all the open source components that you're using in your product. And what are those components? What are the licensing obligations of each of those components? What is the life of that component? And you can get into such a complex discussion on that the product will never see the light of the day until you resolve all these things. So all these things become part of product management. The roadmap, where that product will be 6, 12, 18 months from today. What is the technology stack? What functionality you are planning to add? Or let us say you are developing something and you say that you realize that what you are developing eventually must go and park itself in some accounting system. So if it is on your roadmap that I don't have it today, but 12 months from today, I will have capability in my product that you can extract accounting data, or you can extract some data from my product, and I'll create it in a format that you can upload into your SAP or Oracle or QuickBooks or any such accounting system. And those kind of assurances are very important for customers to know that this product is going to fit into their ecosystem and not just be a one-off great product that always stands out as a sore thumb, and they are not able to really integrate that into the organization. So this is what I mean by product management, and not some fancy charts and diagrams and that can come, that is easy. But the important thing is, like, look at the current case. We have got a big company here which grew 200% the moment COVID hit and everybody started working from home, and then suddenly hit a huge bottleneck with the security flaws. And its stock started going down, its user base started going down, but they acted quickly. They had somebody, a very large company, come as their technology backend. They hired a very senior person to lead their entire software development work. They introduced some new encryption methods, all kinds of things. But I will spend just 1 minute on this win because I think it is of great relevance to our audience here. I know you are looking at me, but just give me 1 minute.
Yeah, the reason why, Buck, is because we do want to open it up to some questions.
Just give me 1 minute and then I'll shut up. Yes, absolutely.
Yeah.
Why I want to take this example is this company was able to recover because of multiple reasons. A, it was already a post-IPO company and it had the money and the resources to fix the problem. A startup may not have that or does not have that. The second is a very big brand partnered with them that gave them instant credibility. You may not have that luxury. They could hire a very senior executive to lead their engineering. You may not have that luxury. And the problem, this pandemic has lasted long enough for the customers to go back to them. They had a problem, and after 2 days, if the pandemic was over, maybe that company could not have recovered. So I want our people, our audience, entrepreneurs to think, what are the scenarios in which their product can suddenly become unusable to the customer, and prepare for that. And that's a big part of product management.
No, thank you. That's a good point. So we're going to open up to the audience to see if there's any questions that you want to pose to the panel. Certainly what's nice is that we do have a very good group, widespread background. So are there any questions at all? And to do so, if you could use the raise hand capability on Zoom, that can help to identify who you are. And if you can take yourself off of mute to answer the question, that'll also be helpful. And if not, we'll continue to move on. But I just wanted to kind of give the audience an opportunity to ask or to engage if they would like.
Yeah, you have got Betsy.
Oh, okay. Betsy Waters? Yes, Betsy.
There we go. We're unmuted now.
Yes, thank you.
All right. I had a couple of questions. Thank you very much. This was very, very interesting. One question I wanted to ask about was, I think Buck was talking about when you're onboarding, and for fintechs in particularly, and I totally agree with him. With a fintech, it's very important to think about who has to onboard the client. And if your partner bank is the one who's onboarding the client, it does become very difficult because you're subject to that partner bank's KYC. But on the other hand, if you set your structure up so that your partner bank doesn't need to onboard the client, you become an MSB, or you may need to be a money service bureau of some sort if you're touching the money, which is a really kind of, you know, between a rock and a hard place in a way, because one wants to avoid many times becoming a money service business and only be the technology provider. On the other hand, who does the KYC? So I wanted to ask about that. With the onboarding in particular. I thought that was a very interesting point you brought up, Buck.
Right. Yeah. Thank you, Betsy. Yeah. I will say a few things that I experienced, and then I think I will ask Ross also to chip in because there are some legal aspects to this as well. So first thing is, in fact, you know, like same, I keep using the word all the time. What is your total ecosystem or the supply chain for that particular transaction from origination to completion? And do you understand who are the players there? Today, if somebody's using Facebook and introducing Facebook into your Facebook chatbot into your application seems so easy and so exciting and so valuable to customers. But when a customer types that data into a Facebook chat, where does it go? Who can store it? Who can see it? Who can use it? And I can bet you, Betsy, many smaller companies won't have a clue what happens to that data, and they have no control over that. So those are the kind of things that are happening in the fintech space today, and including some fairly experienced and established fintechs, not just the tiny startups that I'm talking about really. So what is your ecosystem? Who are the players? Are the responsibilities of your customer and your customer's customers? You know, for example, in payment world, we call them billers and sub-billers and all those things. So do we really know who are they? What are their responsibilities? Is the process clear that I am required to do the AML KYC, or am I required to collect data from my customer, which certifies that the bank has performed the AML KYC, and can I use it as a basis? So there are two important points, and that is why I thought it will be great for you and Ross to weigh in on this. But two important points are a discussion or an argument or even a legal matter later on about who was responsible many times is purely academic, because really speaking, all of us are responsible because the data in one way or the other came into our possession while we were processing that transaction. Whether we were the acquirers of that data originally or not is not really all that important. But did it come in our possession? If the answer is yes, then you are responsible for almost all the regulations. And the second thing is, what are you going to achieve by fighting with the customer? You know, especially when you are a startup. The customer says, no, you should have done this. And really speaking, there is not much to be gained by fighting on that point, because anyway, it's too late. And you have got a one big customer, and instead of developing that customer and taking it to its full potential, you have a quarrel going on, and obviously nothing is going to work for you anyway. You can't afford that fight. So that's where I would say invest in this. If necessary, install some backup systems. And the traditional argument is, oh, but we are a startup, we don't have the resources. That's not the correct way to look at it, because it is not an optional thing to do. If you get this clear in your mind, that this is a necessary part of my product development. It is not something that is an afterthought I can add, or I can get to it when I got some more money or time. It's not going to work.
Thanks, Buck. And Ross, do you want to tie in? We do have another question, but if you want, do you want to tie in to add to a response to Betsy's comment?
Sure, and I think it was a great comment and a great response. And I think the underlying idea I would add on is to just jump onto what Buck has already said, really, is that these types of issues, what are we going to be? Are we going to act as a money services business, which is going to require compliance with FinCEN registration, having to register with the Department of Treasury, or are we simply acting as a white label, which may still require certain regulatory registrations, maybe FINRA based upon what we're doing? Those types of questions need to be answered at the very onset, and you need to understand the risk tolerance involved depending on the path you're going down, and also be in a position to explain that to your future investors, because the more you have to do on the regulatory side, the more resources you're going to need to get there and ensure continued compliance.
Okay, thank you. Thank you. And thank you, Betsy, for posing the question. We do have another question. And this question, Christine had asked Buck, and this is to Buck, and then we can all chime in on this. But Buck, the question is directed to you, but obviously Ross and myself, we want to think about it as well.
Mm-hmm.
But can you elaborate more on the concept of the whole ecosystem? If you are a startup, how do you compete by integrating all aspects of the entire ecosystem for your new business? And what will that definitely improve on your business platform?
Sure. Yeah, that's a great question. So ecosystem, like I said, in fact, in the previous question as well, who are the players from the origination of the transaction to the completion of the transaction in the earlier context? In this context, we'll just extrapolate that to the business itself. So it's very good to know what is the total supply chain that is going to play to deliver a particular service to a customer. And in that, what role do I play? You obviously should not try to do everything. There are very large companies which are trying to do everything in the whole supply chain, and they are also failing miserably. So obviously a startup should not be even thinking of doing that. But not knowing about that ecosystem definitely becomes a big handicap for you. And don't think of ecosystem just from the vendor supplier perspective, but in fact, in the fintech world especially, your customer is probably the originator for many transactions, and you are a downstream entity or some such terminology that they use in compliance. So what exactly are you? Are you a business associate? Are you a downstream delegated entity? What exactly are you in a particular transaction supply chain? Even your investor, I call him as part of the ecosystem. Are you aligning with your investors' thinking? Are you aligning with your investors' goals? Is your product roadmap the same, or is your product roadmap capable of being superimposed on your funding requirements? Or funding happens on a different cycle, product release is happening on a different cycle. So how do you establish that this ecosystem is working in tandem? That's what I try to help entrepreneurs understand and achieve when I talk about the ecosystem part of it. Does that answer the question?
Okay. No, good. Ross, do you have a perspective? If not, that's okay.
I really think Buck summed it up very well. I could only do him dishonor by continuing to answer that question. So
no problem. Thank you. Thank you. Again, we welcome additional questions. If not, we're going to move. Oh, here's another question. Yes, Christine, you did answer the question. Thank you, Buck.
Thank you.
So Ross, what should a company who anticipates a capital raise be mindful of? If there are any pitfalls that they need to be aware of, any challenges? Obviously, this is a very sensitive situation that any startup kind of goes through their trajectory. But obviously, what should they anticipate as they go through a capital raise? Why is that important?
Absolutely, and it's a great question. It's a loaded one that we could probably speak for hours on. But in a concise format, I'd say that there are sort of two layers here. Number one are the proactive steps you can take to get to the point where you're in front of an investor. And then there's the reactive component of receiving a term sheet if you get to a Series A or further, and ensuring that you have an understanding of how to work with those documents to negotiate best terms. So as for proactive steps to take, it's always be prepared for due diligence from day one. If that's one theme and takeaway we can have from today, I think it's that we have an understanding that all your legal paperwork, so all your documents for the company, corporate resolutions, contracts with vendors, your employees, accounting, books and records, you should really always have a bookkeeper, ensure that your company credit cards are being used for company purchases. Have documentations of your intellectual property registrations. And if they're not finished with registration, where in the process are you? You want to be able to have all of this compiled together. ideally in a secure format online, so that if an investor says to you, you know what, we'd like to get to the due diligence stage, can you send over a list, which could be exorbitant, of documents they'd like to see, you can do that really quickly. So you're not being reactive, you're being proactive. You're not scrambling and calling up your team saying, we've got to find this document, we've got to find that document. I can't tell you how many times I see that in early on companies. They just never bother to pay attention. Number two is just remember, you know, for founders, when they're getting ready to pitch to an investor, people are investing in you. I know that's something that we hear often on social media. Remember, they're investing in you, not in something else. But that's a very important mindset to have. And when you are before an investor, you're not pitching to a customer. I do see a lot of the times when I work with a client, sometimes they're piecing together a pitch deck or they're getting their deal flow ready. When they're in front of the investor, they're so product focused that they don't exactly answer all of the pain points that an investor wants to know about the equity relationship, about the return they can expect, about when they can expect it. What do we do in certain situations when it looks like resources are scarce? So those are things to keep in mind. Also, and this speaks a little bit more, I know we have some Canadian callers on this call right now. Location does matter when you're seeking that initial investment. So statistics tend to say that a company that is acquired is often acquired in close proximity to where an initial investment's made. So if you're out of the United States and you'd like to ideally be acquired by a US company, you should really seek to be working with a United States venture capital company. Maybe you're going to Silicon Valley, doing your research and connecting with companies there. And I would also be mindful, if you're at that stage now where you're sort of researching various VC partners that you're involved in outreach with, check to see where they have been investing, not only within the industry, not only with financial technology, but location-based investing. If they haven't invested out of the United States or out of California, they're probably not going to start doing that right now. Same thing can be said for if you're a Canadian company looking to invest with a Canadian investor. Find out if they have any ties to the United States, if your end goal is to be acquired by a US company, because the more contacts they have, the more interactions they have with US-based companies, the more likely you are to be able to eventually get acquired. I think that the next stage of things is to learn what term sheets are. I know we'll discuss that in a few minutes, but certainly when you get a term sheet, understand what it is, understand how to negotiate, and be mindful of concessions that you can make, you know, because it's okay if you don't get everything you want, versus the ones that you really don't want to make because maybe it doesn't affect you now, but 5 or 10 years down the road, you're looking back saying, gee, I wish I'd understood what I was looking at about 8 years ago or 7 years ago, because now, you know, we're getting acquired and suddenly I'm in a very weak position.
No, Ross, thank you very much. You know, and the reason why I think this is really important, and I want to open it up to any questions that anybody may have at this particular point, because this topic is very relevant. Some startups, some CEOs, some founders are concerned, especially during these particular times, what the outlook looks as far as capital raise and so forth. So I just want to kind of open it up to the audience if they have any questions at all. Let's see if we can take those. I see one. Yes, we do have one question for the panel, and we'll raise this one to you, Ross. Debbie had asked, at what point do you typically see that people with an idea turn it into something you write down on paper, legitimatize, and put major financial investments in? Sometimes it's difficult to know if the research comes first and what research is necessary for you to do versus hire someone to do it, or the idea. Excellent question, if I may say so, Debbie. So should we break that down in components? Ross, you want to answer that question, then Buck will go to you, and maybe we'll all chime in.
Mm-hmm. Sure, absolutely. And I wish there was a way to see it. It's a wonderful question. You know, first and foremost, I think when you're at the very beginning stages and you have an idea, you're going to want to do that market research. You're going to want to figure out what your competitors would look like and figure out the demographics of where you can best perform. I think at the very beginning, that's when you start to piece together the ideas for a business plan. As you continue to move forward, this is typically when you get in the early on investing. Maybe it's a family and friends round, you know, that pre-seed investments where you can kind of pitch an idea to those you know to get a little funding with the goal, I think, of eventually getting to a minimum viable product. If you can do that and get to an MVP, I think at that point, that's when you're really positioning yourself to say, to do even more market research, to maybe start outsourcing and hiring companies to assist you with that process, but now to be in a position to have an MVP, to go to and to get more serious investments that could really start to range, in the hundreds of thousands, if not into the million, 1 to 10 or $1 to $2 million range. So it really depends on the market. It really depends on what your focus point is for your product. But essentially, I think that once you have that MVP, you're in a position to really gain that significant financing.
Yeah. So with regards to that question, sometimes it's difficult to know if the research comes first and what research is necessary for you to do versus hire someone or the idea. Buck, do you want to chime in on something on that comment, or do you want to leave that to to Ross?
Yeah, I think Ross has covered it well. So
yeah. Good. So we hope that answered your question. And just from my perspective, by working with so many startups over the years, it's a very good question. And the big thing is that it's challenging to know when to do the research, when to bring that research in, when to do the business plan. I strongly think by working with a number of startups, I've seen business plans pivot constantly throughout the beginning stages. I think having a business plan is very good, but I've seen successful startups that have a very stealth business plan and have become very successful. So there's so many different areas all over the map to respond to that. But it's interesting in regards to the tolerance that a CEO founder has on wanting to have all the ducks in a row and to be comfortable with the structure, as opposed to kind of not. And it just takes all different phases and it takes a life of its own. But we thank you very much for that question, and we hope that we're able to provide that answer back to you, Debbie. Thank you. Does anybody have any other questions before we move on in our time? Because our comment was winding down, but we do have a little bit more questions that we want to raise to the panel. But of course, your questions are important, and we want to just give a few seconds to see if anyone has any question that they want to write in or using the raise hand feature. Okay, so let's go to Buck. Buck, and this is to a CEO, a founder of a startup, how do you scale up and down your business as per market situations? We know that the current pandemic is giving us lessons that we really never thought of before. And some may see this period of time as being filled with challenges, which it is, but it can have an impact on scaling up and down. What are your thoughts?
Mm-hmm. Yeah, I think the current situation has shown very harsh light on your ability to scale up and down. And so far, last few years, there was a big migration to cloud. So moving from your in-house data center to a cloud has helped a lot of people achieve that scalability up and down. Scalability comes in two forms, in and out versus up and down. So you need to really understand what you want to achieve here. So technical scalability is one part, but I think it is relatively easier to get. Most people get it already. Equally important is the scalability of the organization. Like it is happening today. Can your business continue to function if nobody can reach office? Can your business continue to function if some of the basic physical activities do not take place in the office? So that is also part of scaling. And companies that invested, many of you are aware, and many startups, because they don't have the budgets, they don't have the part of the plan, they don't invest early on in things like ticketing systems or workflow systems. But right now, last 3 months, there is a very clear evidence in the market that people who had created ticketing or essentially workflow systems in applications like ServiceNow or Atlassian, they are able to continue offering a much higher level of service to their customers. And that has actually become a big strong point for them. Also, how your customers look at scaling. That's another interesting thing. In fact, I worked for a large multinational bank earlier, and I was responsible for setting up a lot of offices in many locations. And some markets, as you understand very well, buying real estate is much more lucrative and much more beneficial than leasing real estate. And you are able to get good deals if you've got the money to buy properties. And in spite of that, my bank would say that, no, we are not going to buy anything. We are going to lease everything. And I said, we are losing, opportunities. This is appreciation. We are going to make money doing nothing. But still, it was a clear no. And after quite some time, I understood that the bank had a business continuity policy, which was that they must be able to get out of any geography location in 72 hours from the declaration of the emergency, which included their infrastructure, data, servers, people, expatriates, you name it. So this is how critical the planning becomes for you to be able to scale, move from one location to another quickly. So cloud is a good start. but definitely don't stop at cloud. As an organization, can you scale up and down? And again, I'll quickly refer back to my ecosystem theme, that if you have built an ecosystem of partners, your ability to scale up and down is far greater than having built a 2,000 people organization of your own, because then there is no scale. You have to either get rid of people or you have to hire people. You're not able to take advantage of other partners who have built the capability, and that can be available to you by paying a little more premium as compared to your own cost of doing it.
No, thank you. Very good. We appreciate that comment. We're going to take a little shift with our discussion. We know that we're winding down to the time. And so what I want to do, just a little bit different for what we thought about, is to elicit your final comments. So this would just be your final thoughts with regards to what we talked about today, just as a final thought of anything that you want to share, to incorporate in your final comments to the participants. We'll start with you, Ross. Ross, just as your final thought, your observations on what you presented, what you talked about. Any thoughts on that?
Well, I think from the legal perspective, there's a saying in the legal world that lawyers always hope for the best, but plan for the worst. And we can discuss the psychological components of what that means for people in general, but nevertheless, I think if you're a business owner, if you're a founder, the idea is to just be mindful of every single day that your business is running. What's happening around it should always be papered, should always be documented, and it should always be done through the lens of, at some point, I'm going to get before venture capitalists, and I better have my documentation in order, because my ultimate goal, if I'm looking to scale, is to continue to raise capital and to go through various rounds of capital raises to ensure that either we can get have a great exit plan and a great exit strategy, get acquired, or maybe even IPO. One quick thing I just would love to mention is, on term sheets, I know we didn't really get around to discussing them in general, but I just think it's important for people to remember that these are non-binding documents. I find that I have a lot of people come to me say, well, we signed a term sheet, so we know that we're going to get an investment, only to find that after the due diligence process, they don't get the funds, but the problem is the founders already increased spending significantly. So things like that you should be mindful of. And in terms of just moving forward, aside from just being protective of your business and protective of your brand and reputation, is to know what you're getting into when you're getting capital raises. So look at those term sheets, understand them. If possible, for example, don't give up a majority on the board of directors. Be very mindful of no shop clauses that come up in term sheets, because those essentially do not allow you to negotiate with multiple investors at the same time. And be mindful of some other things like cumulative versus non-cumulative dividends, et cetera. I could go into a host of items. I'll stop there. But it's more about being protective of your brand, being prepared for capital raises. And then once you get those raises, knowing how to ensure that you don't lose out on your equity, or you ensure that you're able to remain a part of the company.
Thank you, Ross. Buck?
Yeah, sure. I'll just quickly add one point to Ross's remarks. That is, you have got your term sheets, you have got your expansion plans, all that is in place. Build your company from day one with due diligence as a daily goal. It is not something that you do when you are going to meet a prospect, or when you are going to meet an investor, or when you are going to meet a customer, but do it absolutely every day, that you are due diligence ready all the time. That's and it doesn't take much. It just takes the basic discipline. So now I'll come to my closing remark that I would like to share with everyone. I think it can be a great benefit to many entrepreneurs, is that have your exit strategy when you start the business. Today, the things are so different with the investing community. They have become very savvy. They have got large technology companies with multi-billion investing arms. All of you are familiar with them. So I look at exit strategy, really speaking now, as the back end of entry strategy. You can build a business today by saying that, okay, the goal of this business is that in 4 years' time, I want Google to buy this, or Amazon to buy this, or somebody else to buy this. Or I'm a fintech. My goal is to sell this to 3, 4, 5 big banks. And 5 years from today, I want a bank to buy me. Or it can be doing an IPO. But knowing this as to what you want to do is so important for the daily discipline that you have in your thinking, or the strategy that you plan. Because once you know In fact, today, many of you know, right? Many of you are technical people too. Your technology stack is, spread over 3-4 large vendors. You've got something from Microsoft, something from AWS, something from GCP, something from RSA, all those things. And you realize that when you go deeper and deeper and deeper with all these people, at some stage, your product becomes of no interest to each one of them, because they know that along with their technology, you are using 70% of other competitors also, and that's not a very attractive thing for somebody to invest in. So exit strategy, right from day one as part of entry strategy, is something that I would love to share with all our audience today.
Thank you, Buck. So my final comment is that we really do appreciate the fact that you joined the webinar. And we also appreciate your feedback and your comments, and that's to the audience. We know that you may have some additional questions, and if so, feel free to engage with us, reach out to us, let us know what those questions are specifically. We do know that that we are out of time for as far as the time allocated for this webinar. The other aspect that we want to communicate to make sure is that we would love to get your feedback. What worked for you? What didn't work for you? What could work in the future, because of the fact that there'll be other webinars that we will be hosting in the future. And we really want to make sure that the information in the webinar will resonate to you as our audience. So certainly we look forward to your feedback, your comments, your critiques. We can handle that. The most important thing is that myself, Ross, and Buck, we are very passionate about the industry of fintech, financial services, to really help companies to continue to grow. This is how we spend our career and our life. So we would love to hear back from you as we move forward. Again, we thank you very much again for your time. We look forward to hearing from you. We do have one more question. Oh, okay, we'll take that. Thank you. Okay, well, thank you as well. Thank you very much. We look forward to hearing from you again. Thank you.
Thanks, everyone. Have a great day.